Welcome to the CEC Report. It's the 14th of July. I'm Robert Barwick and I'm joined today again by CEC leader Craig Isherwood. Welcome, Craig.
Yeah, thanks, Robbie.
In this week's CEC Report, warning to Australian investors, beware bail-in bonds. And if you don't want World War III, don't accept lies about the South China Sea. So first, warning to Australian investors, beware bail-in bonds. Craig, we have an alarming situation in Australia that anyone who has superannuation, especially self-managed super funds, because they're being targeted, and people who want to be self-funded retirees, or just someone who's tempted to invest a bit of extra money on the side, retail investors I'm talking about, mums and dads and people who aren't sophisticated investors, right? They are being preyed upon by the system at the moment, and thanks to the bank regulator, APRA, whose job is supposedly to protect them, it's a complicit in this. It's throwing these investors to the wolves because it's letting banks, Australian banks, sell those investors a certain kind of product, which is a complex product called hybrid securities, which is also known as bail-in bonds, right? Now, like I said, these are complex. So what they're doing is the banks are sucking investors in by offering them high interest rates, and my God, are they high. So for instance, a few months ago, Commonwealth Bank issued $900 million worth of these bonds, Craig, at 7.5% interest. So if you're an investor in this low interest environment where you're scratching around for 3 or 4% interest, right? And then the Commonwealth Bank, Australia's biggest bank, Australia's strongest bank, offers you, buy a bond with us, we'll pay you 7.5%. What are you going to say?
Well, they've got no choice, Robbie, because you can't exist in this low interest environment terribly well. So the thing is with a bond, usually when you sell a bond, that bond is guaranteed to be repaid.
Yeah.
And they're considered, one of the gilt-edged sort of securities that you can.
It's effectively a loan you're making to the institution or the government, and there's a set repayment period and set interest rate.
And there's two issues here. First of all, the banks are selling these things on their reputation.
Yes.
First and foremost, right? And secondly...
Well, the article in the Financial Review that reported this a little while ago said the investors banks are targeting trust the banks.
Yes.
And that's why the banks
and
are targeting.
And the other thing is that it's being supported by APRA, and APRA is not a transparent organisation. And people don't trust APRA at all, because the question is that where does APRA's loyalties lie? Does it lie with protecting people's deposits really, or does it protect the financial stability of the system, i.e. it's got to protect the banks?
Well, this what we're talking about today really gives the proof to that answer, right? APRA is not there to protect the Australian people because they're allowing these bonds to be sold. Yes, they've got a high interest rate. That's going to suck a lot of people in. But what the people will not realise, because they're very complex, embedded in the product are numerous triggers. And there's, when I say numerous, there's all kinds of circumstances. A share price hitting a certain level or something else like that can trigger that bond to become virtually worthless overnight. They get converted into shares.
Or written off.
And even if they're shares, right, well, there's a big difference between holding a bond in a bank, Craig, and shares in a bank. Because if you hold a share in any kind of company and that company goes bankrupt, your shares are wiped out. No questions asked. If you hold a bond, you're at least one of the creditors that gets to be eventually paid back when they sort through the rubble of the company, right? So this is, by letting them convert into shares, they go from being something worth a lot to something that's worthless.
Robbie, just to explain this mechanism, because it's in the fine print, and most people don't read the fine print, but there's a very important ratio that the international banks use and the local banks use called the CET1 ratio, which is called the Common Capital Ratio, or Tier 1 Common Capital Ratio. And that's made up of the equity of the bank. That's the shares, right?
Yep.
Plus some of the retained earnings and so forth, as a ratio to their assets, but they're risk-weighted assets.
Yep.
Now, risk weighting is one of these tricks that's been brought into international banking over the last 50 years in order to compare one bank to another. Because assets, they say, have different risk weights. Now, for example, if you've got gold in the bank, well, that's 100% guaranteed. So you can count 100% of the value of that asset, if you've got things like housing loans, this is the interesting part, right? If a housing loan is issued, and of course these are considered assets to the bank, where someone has got more than or less than 80% equity in that house, they own say 50% of the house instead of only 10% of the house, then that loan can be valued at say 50% risk weighted. So what happens is they add up all these asset values and they divide it through the ratio, right? At the moment, our banks sit somewhere between 8 and 10%. That's way above what's considered adequately capitalised, which is 6%. But that's the trick, because if you scratch the surface and you have a look at these so-called assets, what happens in a housing collapse when our government, or not the government, but the banks are exposed to a massive crash in the value of housing? Well, what happens is the assets collapse, and then this ratio collapse. When the ratios collapse below 5.125% or something it triggers these bailing bonds.
And if you took out the risk weighting component of this formula you're talking about and just had capital versus assets, the banks claim they got 8 or 10 or 12%. In actual terms, they got 2%.
Yeah.
And 2% in any language is a catastrophe. Craig, in the 1890s, something like 20 out of 22 Australian banks collapsed in the 1890s depression. The solution to that afterwards, all the way until the Great Depression, was the banks in Australia all had to have capital of 20%, actual capital of 20%, and no bank collapsed all the way from the 1890s, even through the Great Depression in Australia, because that capital certainly worked, right? It was rock solid capital. Yeah. So you compare that extreme as a standard to our banks today having in practice less than 2% capital, right? And these are the things where they're risk. It just means what they're doing is risky. And why are they called these bonds are called bail-in bonds? And regular viewers will understand that we talk about this bail-in policy a lot, because bail-in is the idea that when a bank gets into trouble, instead of being bailed out by government with taxpayer money, there should be mechanisms to grab the money of the people with an interest in the bank, including the depositors and the investors, and bail them in to the bank to keep the bank propped up. Well, these are bonds that are specifically sold ahead of time to be that mechanism, and that's why these triggers are written into them. So we compared it, we did a press release on this the other day, and we compared it to the banks being careening along a cliff's edge with Australian investors strapped to their bumpers as human shock absorbers, right? That's the point of this. The investors wear the losses that the banks incur through their gambling, not just so the bank can stay up, Craig, but so the bank can continue gambling.
Yeah, so you have all these self-managed superannuation funds that have got a lot of money in them. They see the 7% return. They say, oh, look, the banks, they're by reputation, they're sound. They buy into these things. They then immediately are going to be the shock absorbers or the loss absorbers for the banks.
And if that's not shocking enough to listeners, understand the worst part about these bonds being sold to Australian retail investors is that in the UK, it is illegal for UK banks to sell the same bonds to retail investors. You can sell them to institutional investors where some guy with a finance degree is buying on behalf of a fund and knows how to gauge the risk of these things, but you can't sell them to mums and dads and self-funded retirees. It's illegal because they're so complex and therefore so dangerous, but in Australia it's open season. And this has become an issue, there's a whole issue in Europe at the moment where since Italian investors in Italian banks lost a lot of money on similar bonds in December, Craig, a lot of them were wiped out, people committed suicide, etc. The European banks outside of Australia, from what I can tell, have been the most aggressive in selling these bonds. And when people realised what they were, thanks to these losses in Italy, everyone headed for the hills. In February this year, the European, they call them COCO bonds there, contingent convertible, which means something happens and they can be converted. The market froze up. Nobody was buying these bonds. However, in Europe, under the bail-in law they've got there, these bonds were being, the banks were being instructed by the central banks, like the Bank of England, you've got to sell these bonds because they're part of your extra capital that we're requiring you to have. Not real extra capital, But fake extra capital, this human shock absorber idea, sell these bonds and that will be the part of your bail-in when it happens. And the banks were saying, well, yeah, you said that, except now the very fact we're trying to sell these bonds, now people know how worthless they are causing everyone to freak out, and they're supposed to be the source of stability, they're causing instability. Ian Mackay, who was the finance director of HSBC back in April, he on behalf of his bank, he refused to sell the bonds, and he said, the fact that the UK watchdog had banned banks from selling cocoa bonds to retail investors, quote, tells you everything you need to know about the complexity of these products. So that's the European case. The president of the Minneapolis Federal Reserve, who was a guy pushing for a proper reform of the banking system because he said, we still have too big to fail, none of this is solved, the risk is still there in the banking system, all these regulations that have been passed since 2008, they're kidding themselves. He specifically criticised these bonds in Europe, saying, look, like the bankers in Europe did, look, they're supposed to bring stability, instead they're causing instability. So that's the European picture. So why is APRA and the Australian authorities allowing these bonds to be sold to mums and dads in Australia?
Because we've been successful in defeating the actual attempts to get bail-in legislation here, where, Robbie, the banks can literally take people's deposits. It's being done in Cyprus, it's law in the UK, it's law in the European Union, where if the banks get into trouble, the government can take all but 100,000 euros of people's deposits. Now, we've been mobilising on this issue since 2013. We've created an enormous political stink about it. The government doesn't dare to go there on actual bail-in legislation, so they're doing it through the back door because they have to protect their so-called financial stability of the system. And the only way they can do that is literally get their hands on the liabilities to the banks, which are in fact our deposits.
Yep.
And that's what people have to realise. This is just a slightly different mechanism. It's going through the back doors. There's trillions of dollars in superannuation funds, and most people don't even know how their super is being used to buy these sorts of things.
So we're going to take a break now, Craig. After the break, we're going to talk about some of the actual triggers for the new global financial crisis that are looming in Europe. The main point for viewers to understand is, as that's looming, the banks are thinking of the Australians and Australian investors and mums and dads as their human shields, right? That's what is at stake here. So let's take a break and we'll see you after the break. Welcome back to the CEC Report, where we're warning Australian investors they're being set up to be human shields for the banks in the next financial crisis. So now we're going to discuss how rapidly that financial crisis is looming, Craig, to prove that the discussion we're having about these bail-in bonds is not theoretical. Something big is afoot.
This is a political discussion, Robbie, because there's a political solution to this. You'll
of course
put it on the table first, and that is that we need to go back to a Glass-Steagall proposal, which was from 1933, from Franklin Roosevelt, where he separated out the commercial banking system from all this speculative banking lunacy that we have today. And this is another part, these bail-in bonds are part of the speculative lunacy.
Exactly, and because since 2008 the powers that be have refused to go the Glass-Steagall route, and they've left the speculative banks reign, they've kept the public exposed to the consequences.
And we're doing the job of informing the public about this danger.
Okay, so the situation we're in right now has just this last week has been compared to the collapse of Bear Stearns in early 2008. Now, why that was significant is because when Bear Stearns collapsed, at the time, nobody knew what Lehman Brothers was going to do in September of that year. However, the collapse of Lehman Brothers was already within the collapse of Bear Stearns. Bear Stearns was the fuse, right? And so where there's things happening, especially in Europe right now, that are potentially a similar fuse. So we'll just go through them. The Economist magazine this last week has a cover, which you'll see on the screen, called The Italian Job. And so you see that the British have gone over the cliff because of Brexit, and Italy's following them. The specifics of Italy is they've got a huge problem with non-performing loans, and it's a monster problem. However, as one Italian economist pointed out, the actual problem is not the Italian banks per se, it's the Italian economy, thanks to what you call neoliberalism, privatisation, deregulation, the whole globalisation thing that destroyed Italy's productive economy. That's why the loans are non-performing, but it's a problem. Now, Europe, Craig, the umbrella of all this is Europe has a bail-in law, right? It's been in effect since the 1st of January. And under the way the bail-in law works is the governments of Europe, the EU, like the Italian government, are forbidden from bailing out their banks because when those banks get into trouble, they've got to be bailed in first. And the Italian Prime Minister is protesting this because he's saying, we've got a big problem here. We should, look, if we don't do something to nip it in the bud, this could trigger a chain reaction. But then he made another more fundamental point. He was in a visit to Switzerland, Stockholm or something the other day, he said, the Italian Prime Minister says, if you think Italy's problems are bad, Europe's are worse. And this is his quote. If this non-performing loan problem is worth 1, the question of derivatives at other banks, big banks, is worth 100. And he's specifically referring to Deutsche Bank. Deutsche Bank, one of the biggest banks in the world. It's actually a bank that's very influential in Australia, Craig. Joe Hockey's wife, Josh Frydenberg, Joe Hockey's chief of staff, and a bunch of other people around the federal government of the Abbott-Turnbull government were all Deutsche Bank people, right? But Deutsche Bank has this massive derivatives exposure, $54 trillion. It's been called the most volatile bank in the transatlantic sector, and it's got a leverage of 40-1, which is greater than Lehman Brothers when it imploded. And we'll put on the screen a picture showing how Deutsche Bank's the middle of a web, connecting it to every major too-big-to-fail bank on the planet, right? So if Deutsche Bank goes, this could be that Lehman Brothers style event. And so not just the Italian Prime Minister, but others are saying, we've got to suspend bail-in, let us do something to address this. Of course, what they're proposing to do is not adequate. You need Glass-Steagall, but at least suspending bail-in is a good idea. Another trigger, just quickly, is there's, since Brexit, this is not so much a cause, but London is a bubble, and especially as a property bubble, par excellence. But since Brexit, because all these outside investors are worried that businesses based in London serving Europe will have to move to Europe now, there's been a rush of investors out of commercial property funds that are invested in London, and those funds have all frozen up. And if those funds freeze up, that means the commercial property they're based on will lose value. And if it loses value, the owners of that property will not be able to use that property as collateral, and these are usually companies, they won't be able to use their property as collateral to borrow money from the banks for their investments, etc. So there's a knock-on effect from that. And the London bubble is so big, that knock-on effect is potentially pretty huge. So these things are happening right now.
And of course, Robbie, that's going to affect Australia because Australia has a lot of dependency on getting foreign loans to roll over the existing loans it has. And once this starts to happen, you'll get what we had in the global financial crisis of a freeze-up of banks and other institutions wanting to loan capital. Freeze. And once you get that freeze, Rob, the whole system can come down. Okay, and so that's the point we're making there, apart from giving the viewer that information, is that this is the stuff that means our previous discussion of the state, what investors in Australia are facing is not theoretical, right? The next GFC is looming and it's going to affect the whole world. So we'll take another break and then we're going to change the subject and talk about this ruling on the South China Sea. Welcome back to the CEC Report. Finally, if you don't want World War III, don't accept lies about the South China Sea. So this week, Craig, big news, the Permanent Court of Arbitration at The Hague has ruled against China's claims, territorial claims in the South China Sea. The media reporting in Australia is pretty one-sided, right? It's sort of, China is trying to dominate its neighbours, it's all bad, the ruling's good, yada yada. So we're going to give you a different perspective. Before we go through some details though, there's a rhetorical question for the viewer. Should we go to war over this issue? Let's put that out there first, right? Because that's where this is heading unless our side, US, Australia, etc., stops being nuts about this. So first of all, here's some details. China has rejected this ruling completely. And does that mean China is just saying international law doesn't apply, get stuffed? Well, no. China rejects it on the same basis that the United States would reject it if it was a ruling to do with their claims in a sea, because the United States does not accept the jurisdiction of that court, and neither does China, right? But it was the United States that encouraged the Philippines to put up the case to the court. In the previous presidency, Robbie, that's now all changed,
exactly.
Which is very, very important because the current president has got a completely different attitude. So this is
So it shows you it's not a one-sided issue where there's, China's all bad. The Philippines can't even agree on this. So the previous government put it up, they've been voted out, the people have voted this new guy in, and they've said, well, we're not that interested in this decision, we're more interested in collaborating with China, right? And, by the way, the constructions that people hear on the news that China has done with these, sandbanks and whatever, they weren't the first to start those constructions, right? All the players have built their own constructions and China wasn't the first. China has also said it welcomes total freedom of navigation for all trade through the South China Sea. And why wouldn't it? Because it trades with China, right? That's why ships go through there. They're going to take goods to China and bring goods back from China. China has said, however, it does not welcome the US with its massive fleets of Navy ships thinking that it can go and throw its weight around the South China Sea. That's what it has an issue with, not freedom of navigation for normal vessels, the United States. However, in Australia, Craig, we have a special character in the Parliament whose name is Stephen Conroy. And I think he grew up watching Yosemite Sam videos or something from his home in London before he moved over here, because he is a Labor guy, he's Labor's defence spokesman, and he is demanding that Australia, just like America is insisting it's going to do these military exercises in the South China Sea, that Australia go and join these military exercises in the South China Sea. I want to point out the name of the sea we're talking about. It's not the South Australia Sea, it's not the South United States Sea, it's the South China Sea. Why might that be called the South China Sea? Because where is it near?
China?
China, right? In other words, don't pretend that China, you might say that this particular line China draws is not legitimate, etc., but don't pretend this is not China's neighbourhood, and it does get to have an interest in this place that if we think we have some kind of a special interest, we are kidding ourselves. And as for us in particular, we have one particular interest in this thing, which is to send our trading ships through there to where? China, because it's not our idea, but they're the economy we most depend upon.
The last thing in the world that we need right now is any sort of provocations, Robbie, that will end up in a war with China. We don't need that sort of a policy. We need to re-establish the policy of, a good neighbour policy, of working in the idea of what we call the Treaty of Westphalia, of the advantage of the other. It's clear that the new president of the Philippines has that idea. I mean, he's pretty tough on crime and stuff, but he's made it very clear that they want to work with China to develop the economically rich area that's involved here. Why don't we do it together?
So is Vietnam, by the way, incidentally,
the
other main player.
The same issue is being dealt with in places like the North Sea, where there was also claims of oil riches, except they developed a treaty and they all work together up there in order to exploit the resources in that particular region. There's plenty of models here, Robbie, but this goes to the heart of the problem in our region, where you do have this US that believes in the Asia Pivot process, where the US has to maintain its supremacy.
And China has said that all the tensions began when Obama announced his Asia pivot, that he was going to start dominating.
And this has all changed now. The world has completely changed from what it was 30 years ago or so ever. And until you have an actual collaboration between China and the United States, we're always going to be at this risk of some sort of war.
All right, well, Craig,
nuclear war.
That's it for this week's CEC report. People can call in, you can hold that up, people can call in and get a copy of this week's issue of the Australian Alert Service.
Everything is in detail here.
It's in detail in there. But thanks for tuning in, and tune in next week for more of the CEC report.